So with the election behind us, sorta, we're going to talk about where we sit today and where we see the opportunities tomorrow. So here we sit post-election day. Not all the results from all the different races are resolved. There's likely to be suits and further tabulations within the presidential election. But getting the question, hey, why is the market rallying so fast after the election, even given some of the uncertainty that we had in the aftermath? The biggest reason for it is markets love split government. So it got what, again, it's historically liked the best in terms of periods of performance. More specifically, what is it getting? Well, it's getting no new taxes, either on an individual or corporate level, which makes earnings worth that much more. Again, a great intermediate to long-term catalyst for equity prices. It's likely to get fiscal spending, always was in either type of administration as we head into 2021. All indications are Powell will be staying in his seat as chairman of the Fed. Again, that means a likely accommodative monetary policy, and the stimulus bill now should be able to get unstuck as a lot of the acrimony in the lead up to the election is passed, and the market's excited to get that as well. So you put that all together, a mixture for a great rally within the markets. That being said, we temper things here over the near term for a few reasons. One, we're at the top end of that trading range, right around 3,500. The bottom is quite a bit below at 32. Again, doesn't mean we'll hit or rise above anything at any specific point in time, but something to be mindful of in terms of risk-reward setups. The other thing is you're getting some mixed signals from asset classes with risk-on type things like small cap stocks doing really well, but risk-off things like treasuries and utilities also doing well. That's usually not sustainable over a long period of time. Given where we're at within that trading range, we think it's likely to resolve itself, the highest probability with a little bit of a pullback. But again, as we head now post-election with the clarity that we have, we think any type of pullback should be viable, a great long-term entry point for investors looking for equity within their plans. The other thing we're looking at and mindful of is just historic gaps and market breadth and the difference between growth and value stocks. That's where I'm going to wrap up things here quickly today. But the gap between the haves and the have-nots continues to grow. In the immediate aftermath of the election on Wednesday, you saw market cap weighted SPY S&P indices outperform equal weighted indices by the greatest amount ever, over 2% in just one day. In short, handful of stocks continue to lead this rally. It's the usual tech names. A lot of people thinking, as they have done in previous periods in history, hey, this is a no-brainer. You just buy a handful of stocks, they go up forever. I would caution you, this is not the first time we've seen this setup, and it usually does not end well for people who, again, abandon some of their longer-term principles around diversification. More broadly speaking, or I guess within that same vein, I want to talk about this dynamic between growth and value stocks. A lot of the lack of breadth, again, less than 30% of stocks are actually outperforming the S&P 500 this year, falls into that growth versus value dynamic. We're going to talk about what's happened, number one. Number two, where value stocks can fit within a lot of people's portfolios. And lastly, what are the catalysts to move you forward? So first, quickly, what's happened? Well, simply the greatest relative outperformance of growth versus value stocks in the history of the market. Not by a ton. There have been plenty of other periods where we've seen this type of cycle. And as Jeremy Siegel touches on in the article we included in the written part of the commentary this week, it tends to happen about every 20 years that you'll get this type of gap widening between growth and value. The last time it happened in 2000, you had a very similar setup, 5 names dominating the market. The narrative out there that value investing was dead, that the gap was so big that it could never even be closed. And what happened? Value made up a decade's worth of underperformance in less than 12 months. Now, not saying that's going to happen again, but I am saying that where we're at right now is not unprecedented, and history strongly would caution, again, abandoning diversification, giving up on mean reversion, which is least likely to happen to some degree. Where do value stocks fit within your portfolio? Well, for most of you listening to this, whether you're in one of our total return type strategies or one of our high income strategies, you have some value stocks within your portfolio. And why are they there? They're there because we believe in diversification. We know that traditionally, not in a COVID economy, but traditionally they're great buffers against volatility. They're great income producers for clients. And again, we want to have them in there knowing again that this mean reversion, this end of a cycle is likely to happen sooner rather than later. What would be the catalyst to help this period end, or to at least see value stocks to get to participate even if it doesn't come at the expense of growth names? Well, a few things. The biggest one being a vaccine, and we should get some news about that at the end of the month, but a return to the normal economy as opposed to just the online economy would certainly be a huge catalyst for value stocks. Second, fiscal spending is likely to trickle down into parts of the economy that the value stocks represent. We think that's a strong likelihood, again, here over the next couple years. And that comes within the context of very cheap valuations. Now, valuation isn't a catalyst, but it does give you a setup for what your potential risk reward is. If you're trading very cheaply, a lot of potential upside. You're trading very expensive, as plenty of names in today's markets are. You've got more. You could have bleed higher, but the risk is quite greater to the downside. Last potential catalyst we want to touch on that, again, Siegel pointed out in his article as well, is just the need for income. We live in a yield-starved world with a 10-year trading around 0.5%, high-quality bonds maybe at 1%. Again, they can be part of your portfolio, but a lot of people need a lot more income, even more total return than what some of those asset classes are likely to give you. And the case can be made that, hey, these value stocks are going to be a great total return play over time, give you some great income stream while you're waiting much above a lot of different fixed income classes. And so as boomers move in, looking for that income to live on in retirement, can be a great catalyst for pushing even the total return of those value stocks up. We'll leave it right there. If you got questions about any of this, how it looks or relates to your portfolio, as always, don't hesitate to reach out. And thank you for watching.